Hello, everyone. Welcome to video 8 of Module 4, Chapter 11. In this video, we're going to revisit charitable donations. Now, when we discussed charitable donations earlier in the textbook, we mostly focused on cash donations. But what happens if we donate something other than cash? So, revisiting charitable donations. The general rules, if you recall, is the first $200 of donations in a given year confers a benefit of 15% on your taxes. So if you give a charity $200, you will save $30, 15% of it, on your taxes payable. If you're in the highest tax bracket, that charitable donation can be 33% above $200, limited to the amount of income in that highest bracket. So if I have $10,000 of income in the highest tax bracket and I donate that $10,000, then I would have the first 200 gets used and then 9,800 would be at that highest rate. Only the taxable income in excess of that highest bracket threshold can benefit at that 33% because that's the income that's being taxed at 33%. 29% is the fourth tax bracket. So anything not using so after the first $200, anything not benefiting from that 33% will be 29%. When you have charitable donations, we're usually limited to only claiming 75% of our net income in a given year. Unused charitable donations can carry forward up to 5 years to be used in a future period. You can deduct 100% of net income in individual's year of death and year preceding death. This rule's in place because a lot of individuals in their will, when you pass away, from the moment of your death, you're deemed to have sold everything. So we have a lot of recognition of income, capital gains, capital losses, and it can really be a large tax bill. But if in your will you say, I leave everything to a charitable donation, well, now you can fully deduct that charity donation from that death date, from the last year of your life at 100%. You no longer have that limitation because if they were to limit to 75% and it carries forward, you're no longer here to claim it. So they do allow up to 100% of net income in the year of death and the year preceding death, depending on what time of year you passed away, if you still have not completed that preceding year's tax return. Donations classified. There's 4 types of charitable donations. Total charitable gifts are eligible amounts donated to a registered charity, a registered athletic association. You can also donate to a Canadian municipality. Also, you can donate to, they say Her Majesty, you can donate to the government. United Nations, a university outside Canada that normally enrolls Canadian students, and charitable organizations outside Canada to which Her Majesty has made a gift in the year or an immediately preceding year. So if the country's donated to a country or a charitable organization and that contribution's modified by contributions already made by Canadians, you get a donation credit for that as well. In your own life, basically, if you donate to an organization, they will give you a receipt. On that receipt will be a registered charity number. If you have that number, that means that's recognized as an acceptable donation amount. So outside of cash gifts, there's also crown gifts, eligible amounts donated to Her Majesty, which I already mentioned. There's cultural gifts where you might gift an object that the Canadian Cultural Property Export Review Board has determined that is an aspect of cultural significance. And there's ecological gifts, this is when you give eligible land gifts. You give conservation, protection important to preserve Canada's environment heritage. So you can gift property to organizations and they can, build new locations. If it's a conservation, they just want that fresh land for animals to live on. So ecological gifts, what do we do when we've gifted land? In general, when you give a donation, the donation amount is by which the fair market value of the property, subject of the gift or contribution, exceeds the advantage. So the advantage is what you get back in return. A great example for this is when they have charity dinners. It might be $300 for a plate. So you spend $300, you go to this charity event, it's fundraising. Not all of the $300 is used to fund the charitable organization. That's the money you've given in. But if your meal cost $100, that's what they gave you back. You gave them $300. They gave you back $100 worth of stuff. Therefore, your donation was only the difference, only that $200 in between. So your donation is what did I give minus what did I get in return? Advantage is defined to include benefit to taxpayer in any way related to the gift. So if the fair market value of the real property gift is 300,000 and the charity assumes a $100,000 mortgage, there's an advantage of 100,000. So yes, I gave them $300,000, but they're saving me $100,000 that I no longer have to pay the bank. So they took the property. It was very generous. Of 300,000, but because I'm saving $100,000 of cash by not having to pay my mortgage, the eligible donation is that difference, 200,000. There are situations where the advantage is minuscule. This discusses lottery tickets. So lottery tickets with proceeds to raise funds for charities. There's a lot of lotteries out there for medical organizations where um, they have big prizes. So the winner might win $1 million home that they can move in and live in right away. So I'm buying a ticket, and that ticket's being used for a charity, but it's also being used to fund this lottery. Lottery tickets with proceeds to raise funds for charity, the series view as since the primary motivation is to purchase a lottery ticket, no part of the ticket cost is a donation. And part of the motivation is I might have this big payout. The ticket costs $100 and I might win $1 million home. So the possible advantage exceedingly outweighs the cost of the ticket. So it generally says my motivation for buying the ticket is the potential to win. So lottery tickets are not donations, even if the proceeds are given to a charitable organization. If the advantage ever exceeds 80% of the value of the gift, then the entire gift is disqualified from benefiting from the donation. So in this previous example, if the property was $100,000 and they took on a $90,000 mortgage, that benefit, that advantage is 90% of the gift, so it's not considered a donation anymore. There's also, if the item is less than $75 and less than 10% of the advantage of the donation given, then it's not included in the benefit. So for example, I mentioned the charity dinner. They might have prizes and things that people can win, door prizes. Because of the scale of the prizes, the value of any one ticket might be only $7. Because my donation amount is $200, that ticket, that $7, door prize ticket is less than 10% of the donation amount. And it's also less than $75. So they don't include that in the total calculation when considering the advantage. It's too minimal. It's too insignificant to the overall cash transaction. So that's not highlighted in the slides, but that's another item that to consider when it comes to advantage. The advantage can be ignored if its value is minimal to the overall contribution. Yeah. So if we give a gift that's not money, if we give a piece of property, then we might have to have it at the deemed fair market value. So this applies whenever the taxpayer acquires property less than 3 years prior to giving a donation or acquires property less than 10 years before gift made. And it is reasonable to conclude the taxpayer acquired property with intent to gift. Normally, the value of the gift is based on the lesser of the cost and the actual fair market value at time of gift. So when I have a piece of property and I give it and I donate it, they will say, well, what's the value? It's the lower of my cost or my fair market value. If the fair market value is above, then I've given something um, that increased in value in my hand. So it could be argued that I should recognize that change in value. I should recognize the gain. If I recognize the gain, then I could recognize the donation at fair market value. But they say, I guess to keep it simple, if I paid $10,000 for it and I gave it away, then my donation's $10,000 and they get it as the cost base of 10,000. It transfers at that amount. But the deemed fair market value comes into play. I don't get the option if the taxpayer acquired a property basically in a short time frame with the intent of gifting it. Legislated to eliminate arrangements such as art flips. So art flips was a big deal when it comes to donations because its value is nebulous. We're not sure how much a piece of art is valued. That depends on how much it sells at auction. So individuals would have a piece of art that they just, they make it or someone they know makes it. They would have it valued at a very high fair market value. Like, wow, this piece of art is worth $1 million, and then they donate it, get a donation credit of $1 million. But they say, well, it didn't cost you anything. So we're going to have it just at the cost of you buying this small piece of art, $100. So that effort was to make sure that people weren't flipping art in, I guess you could call it a scheme to exaggerate donation credits. So normally, value of gifts is the lesser of cost or the fair market value at the time. Gifts of capital property transfer at an elected value. If the fair market value is above the cost base or the UCC, the taxpayer can elect any amount between the fair market value and the cost base, excuse me, for the purposes of determining the credit. This applies to charitable, crown, or ecological gifts of capital property. There's special rules for publicly traded securities and ecologically sensitive land, and I'll talk about those separately. So when we have a piece of property in the fair market value, we have a potential gain on it. We have to think about what we want to do because if we recognize the gain, that's going to be included in income. And then that value that we've selected will be the charitable donation. So we'll have to recognize the income, but perhaps our donation credit will take care of that. So individual Mr. A has a piece of land with the following tax attributes. The cost is 100,000, fair market value is 150,000. Mr. A wishes to donate the land to a registered Canadian charity. Mr. A has taxable income of $400,000. If he receives a tax advantage, such as a cash payment from the charity of $110,000, he cannot elect below $110,000. So if he gives the piece of property and receives nothing in return, he can elect the cost base of 100,000. So he won't have to recognize any income. But if the charity pays him 110, he received 110. That becomes the new floor. He has to recognize at least that much, even though 110 is still a discount. He could still choose 150, but his minimum is now 110 because that's how much he actually received. And yes, they do go through the calculation. So if we use the cost base of $100,000, the tax credit for the first $200 plus the remaining 99,800 at that tax rate of 33% because the income's 400,000, well into that highest bracket. So we'll be able to benefit or experience that full 33% tax donation credit. So the tax credit for the donation at 100,000 would be 32,964. That's the tax credit net of tax. So we'll be able to subtract from our income 32,964. If we elect for the fair market value, we increase our income based on the tax of the gain. So if our cost was 100,000, we recognize it at 150,000. That income of $50,000, that's capital gain. So taxable capital gain is 25,000. 33% of 25,000 is 8,250. So our tax payable will increase by that amount, but our tax credit will also increase. It'll go from 32,000, just short of 33,000, to that 49,464. So our increase in our donation credit minus the increase in our taxes has a net benefit of 41,214. That's savings if the 150,000 is elected of another $8,250. So we would opt to use the election. We would want to use the fair market value at 150,000. We might not always want to use the fair market value depending on what bracket we're in and how much the actual credit is involved. This benefit's very high because we're experiencing that full 33%. But yes, we would have to analyze to say, okay, if I'm going to donate a piece of capital property, what do I want the quote proceeds or the donation amount to be, the cost base or the fair market value? Um, and then there's the question of limits. Now, normally we're limited to that 75% of net income for tax purposes. But we can, but there's a problem. Electing an amount that creates income could result in income that cannot be eliminated with the related tax credit. So if we're recognizing taxable income, that's our taxable capital gains, that's increasing our income. But if we're only allowed to recognize 75%, if we have a year where all we did was donate a piece of land, now we have to pay taxes because that donating that piece of land generated an income and we can only donate up to 75%. So we'd still have to pay taxes on that 25%. So they say, okay, there's additional components for net income based on gifts of capital property. You get to add 25% of any taxable capital gains resulting from the gift plus 25% of any recapture resulting from the gift. So our income is going to increase by the taxable capital gain or any recapture and recapture. If it's a depreciable property, we could have recapture and taxable capital gain. But this 25%, so normally we're limited to 75% of whatever our total is. So by increasing 25% if we have a gain, or increasing 25% if we have recapture, these become 100%. So if I have an asset and I've given it away to a charitable donation, my limitation is functionally 100% of that donation. So I can gift land and not pay any taxes this year. So let's see that in action. Miss Sally Felder donates some food preparation equipment to the local food bank, a registered Canadian charity. The depreciable property has a fair market value of $85,000, a capital cost and ACB of $62,000, and a UCC balance in the class at the end of the 2024 tax year of $28,000. She elects to designate the proceeds of the donation at the fair market value of $85,000, has no other income. Her only tax credit other than the charitable donation is her basic personal amount. Determine what's the maximum charitable donation tax credit we can claim in 2024. In addition, determine how much of the donation she should claim in 2024. Calculate any unused donations to be carried forward. So we have a few steps. I'll move through them. We have an asset that costs $62,000. If we recognize the donation at the fair market value of 85, there's two types of income we now have to recognize. We have to recognize the capital gain, 85,000 minus 62, and we have to recognize the recapture. It was sitting at a UCC of 28,000, insinuating its value had been decreased. That's what we've been expensing, but our fair market value is 85. So we have to recapture the difference between our cost base and our UCC. That recaptures 34,000. So this is the difference between these two. This is the difference between these two. That accounts for the entire difference between 85,000 and where the asset was sitting on the tax return at 28. So capital gain of 23,000 included at 50%. Our income taxable capital gain is 11,005 plus this recapture of 34. Our total income or Miss Felder's income is 45,500. Our donation limit is normally 75% of our net income. So 75% of 45.5 is 34,125. But we get to increase the donation limit by 25% of the taxable capital gain, which in this instance was 11,005, and 25% of the recapture, which in this instance is 34,000. So 25% of those two amounts come to 2,875 and 8,500. You'll notice that if this donation's all we have affecting our income, then that donation limit matches our net income because we're converting that 75% to 100%. So now our donation limit is 100% of the income related to that capital property. If our income's 45,500, that's low enough that we're in the lowest tax bracket, 15%, which means we have a tax bill of 6,825. It says we have the basic personal tax credit, pardon me, so 15,705 at 15%. We're subtracting 2,356 from that taxes payable. So our payable before donations is 4,469. So our total donation was $85,000, but we don't need to use $85,000 to get rid of this much tax payable. So the donation credit used, we are going to figure out how much credit do we need to get rid of our payable. Well, we need to get rid of the $30 that we get for our first 200, and then an additional 4,439. So at our credit rates, that in order to get that $30, we need to contribute $200 at least. And then to get the 4,439, we need to claim 15,307. So the total donation we need to claim this year to get rid of our tax balance is 15,507. So I took my tax payable and figured out using the credits I know I'm going to get, how much that means for my donation credit. So the maximum donation credit is $30 here, and then 45,300 is 13,137. So because of the amount of my donation, my maximum donation credit is 13,167, but I'm going to be using 4,469. So I have plenty of donation credit. 13,000 minus 44 means so I'm using 15,507. So my total donation was 85,000. I've used 15,507 this year. So there's still going to be 69,493. That's the amount of my donation that will be carried forward. I didn't need to use all of it to get that tax payable to zero. To get this to zero, I used 15,500, which means I have just short of $70,000 of my donation amount left. I think it's just okay. I'm going to stop there. I'm going to come back with another short video where I'll talk about gifts of capital property that are traded securities and ecologically sensitive land. See you in the next video.